Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a consolidated statement of cash flows using the direct method, and we're going to have a gain on the sale of depreciable assets included within it. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left. We're going to be working our problem, entering data into the blue area on the right, including our statement of cash flow worksheet, the statement of cash flow itself, and then some more worksheets down below related to it. Let's go to the information on the left. S Corporation was created January 1st, 2000X0. On January 1st, 2000X4, sold percent to P at book value 80%. So in essence, we're talking P parent, 80%. The non-controlling interest at that time, the time we're going to be making the cash flow statement, 20%. We have the statement of cash flows using the direct method. The dividends that went out, we're going to say to the subsidiary or the subsidiary's dividends, 17,000, parent 58,000. Then we have the statement of cash flows using the direct method. That's what we will be doing now. We got our worksheet on the right where we have the consolidated trial balances as of the date that we're going to do the statement of cash flow, or in other words, basically the prior year consolidated trial balance, or you can think of it as the post-closing trial balance after the prior year, including balance sheet accounts, but not income statement accounts, or same numbers as of the beginning of the current year. And then we have the current year information in trial balance format, including the income statement accounts. First thing we're going to do in our worksheet is take the difference between the two. That'll be our similar process that we have seen in the past. We're going to go into the difference column. I'm going to take the 79,000 minus the 50,000. Now it's green because I want to keep this nice formatting of green, orange, and whatnot. So I want to make these cells black now so that you can see that stand out better. So they're blue right now, so you know that we have to do stuff there. Then I'm going to highlight them, right click on them, and let's change them, the coloring to black. So there we have it. Then we're going to take the difference. We're going to take that difference and copy it down. So I'm going to right click and copy. And then I'm going to highlight or select the cells below it. Let go, right click the selected area. And then we're going to paste with the formulas. Paste with the 1, 2, 3. Okay. So there we have it. So there's going to be our differences. Now we're going to use these differences in order to create our statement of cash flows. First item, and remember we're using the direct method, so that means the operating activities up top are not going to be, the indirect methods, basically net income to the statement or the cash flows from operating activities, but rather kind of thinking about it in a system of top to bottom on the income statement, recreating the income statement in essence like a cash basis format. All right, first line item then. We're going to say cash up top is, we got cash received from customers. Now the cash received from customers, the things we typically would think about there is going to be the revenue. That lines up to the revenue line. I'm going to make that green. And the other side would be basically the receivable. Those are the two things that you would take into consideration generally when considering that line item. So I'm going to pick those up down below, and I'm just going to say it's going to be this number. Let's take negative of that number to make it a positive. And then I'm going to be picking up negative of this number. And then I'm going to sum these up. And there you got the 1,098,000. Now I'm not going to spend a lot of time on which way these go, negative and positive. You might want to mull those over. We have another course on the statement of cash flows you can take a look at. Our major thing here is to think about the differences between cash flows from a consolidated statement and those from another corporation or a company that's not consolidated. So we're going to pull that over here. I'm going to say, let's pick that up. It's going to be the cash coming in. It's the wrong number. Hold on a second. Let's pick up the right number. Pick up the right number. All right. And then we've got cash paid to suppliers. Let's say cash paid to suppliers. We'll calculate that down below. It's a little bit more complicated of a calculation. We're going to say cost of goods sold is one major component, one of the major expenses components. We'll look at the other expenses, basically everything else, miscellaneous expenses here. So we're picking up, and this one I'll make this a different color. Let's do that this time. Let's make this one orange. These are the orange colors that are going into this calculation. Then we have the inventory balance sheet account. The change in the inventory is going to be this one. We'll go ahead and make that orange too, so orange. And then we have the item for the accounts payable. So accounts payable, once again, we'll make that orange as well. And then we'll sum this up for the cash paid to suppliers. And so cash paid to suppliers. So there we have that. And we're going to pick that up as our number up top. And this is going to be a negative because it's cash paid of this number. Okay, so there we have that. We've taken care of the revenue line item. And then we're going to have to deal with the gain. So we'll deal with that later. But notice under the direct method, notice it shouldn't be included. It's not an income related item because it's going to be included in the financing activities because it's a sale of the machinery. So we'll deal with that at a later point. It's not included here. And then we've got the cost of goods sold, depreciation, again, not included here because that's going to be, it's a non-cash transaction. So, and then we have the income to the non-controlling interest. Again, not here, not included in this calculation. So we're going to say, all right, let's pick that up. And then I'm going to indent that one more time. Home tab, alignment, indent. Let's sum this up on the right. Okay, and then we got cash flows from the investing activities. So now let's consider the cash flows from investing activities. Major item here is we have the sale of the machinery. Now we know there's a sale of the machinery, and the things that will be involved, of course, is the machinery account here. So we see there's a difference and it went down. So we're going to say, all right, well, something must have happened. Looks like a sale that took place there. I'm going to make that green. I've uncolored everything. I'm going to say that's going to be involved. The depreciation related to it is going to be something that's going to be involved. And we see this gain down here on the sale of machinery. That's going to be something that will be involved as well. So then you might go down and say, okay, well, let's think about basically the journal entry that would be included here. So if we went down and said, okay, it looks like this will be the journal entry. Let's get to the cash last. Let's do that last. The machinery changed by the 150. So we can say, okay, that 150, that's the change in the machinery. Then we've got the accumulated depreciation, the most complex kind of component of this. We're going to say is changing due to the 100,000. Now and this is for the sale. Now notice I'm reconstructing this without having the actual journal entry. In practice, we could dig out the journal entry. We could look at the GL and dig out the journal entry. We're basically backing into it with the information we have here now. We're going to say, okay, this should be 100,000. How would that be the case? Well, the beginning balance was 278. So we had the 278 in the accumulated depreciation. Then we had depreciation expense, which would be the 40,000. So we have the 40,000 in the depreciation expense, which should actually be a credit in accumulated depreciation. So the accumulated depreciation would have gone up by that 40,000 for the depreciation expense. That's what normally would have happened. And then so we're going to consider, okay, what's the ending balance here? The ending balance ends up to be a credit of the 218. So you might say, okay, let's first pick up the ending balance here. You could say, let's first pick up this number and then think about, what the difference has to be to get to that 218, which would be this plus this minus, 100,000. So that 100,000 is then what we would assume to be the accumulated depreciation related to this machinery that we sold. So we sold the machinery for 150. Accumulated depreciation related to it, 100,000. We know the gain because it's on the books right here. There is the gain. It's a credit of the 30,000. Therefore, the cash, we can say, okay, cash must then be the negative sum or the plug, which is the 80,000. So we're going to go up top and we're going to say, all right, this cash, then the machinery, we're going to say it's going to be this 80,000 as we figured here. Then there's a purchase of land, it looks like. Now the purchase of land, we're gonna assume is just a straightforward purchase here. We've got the land went up, so we're gonna assume we paid cash for it. So I'm gonna say negative of that 5,000, like the normal kind of process, and that's gonna be the net cash used in the investing activities. So that'll be the net cash used in the investing. We'll go ahead and sum that up. And there we have that, the 75. Then we're looking at the financing activities. So we're going to look at the bonds. Looks like there was a retirement of bonds given the information we have here because we have the bonds payable. started at the 259 and it went down to the 223. So the assumption then would that be there would be a retirement and therefore payment of the bonds, as they were, because it's a payable that got paid at the 36,000. Then we have the depreciation on the financing. I'm sorry, the dividends on the financing. We're going to pick up P's dividends, which is going to be the 58,000 here. So I'm going to say this is a negative, normal process of the 58,000. Obviously, the dividends are going out. And then we've got to pick up the non-controlling interest dividends. Those are going to be some of S's dividends. So that's why we've given over here 17,000 S's dividends, non-controlling interest, the 20%. So I'm going to take negative of that 17,000 times the 20%, and that's going to be our 3,400. So then we have the net cash used in the financing activities. Net cash used is going to be equal to the sum of these items, and that's going to be the 97.4. So then we have an increase in net increase in cash. The net increase in the cash is going to be the outer columns, operating, financing, and investing, or operating, investing, and financing. Outer column. That's going to be the change we should see here. Then we're going to get back to, of course, this number. So we're going to say, let's add the beginning cash number. And so I'm going to say the beginning cash number was the 50,000. Therefore, the ending cash number will be the sum of those two, or the 79,000, as can be seen on the balance sheet, or our ending trial balance.